So in this video, we're going to be taking a look at some passive income dividend stocks that you can buy right now. Typically when people look at dividend stocks, they only look at the stock for their dividend. But we're going to be taking a different approach in this video. And we're going to be focusing on companies that are really stable during uncertain times like these right now. And we're going to be focusing on companies that have good opportunities to increase their dividend growth. If you like this video, make sure to drop a like and subscribe down below. It will really help out a lot. But other than that, let's get right into the video. So the first stock on our list today is McDonald's Corporation, ticker symbol MCD. So McDonald's has taken a fairly small hit recently. They're down about 14% from their highs, but I think this stock really does have a lot of growth potential in the upcoming months. So as the economy is reopening, obviously they're going to get more business. But I feel like they're going to have more business than ever because McDonald's sells what is known as an inferior good. An inferior good, according to Investopedia, is a good or economic term that describes a good whose demand drops when people's income rise, and the vice versa is true. It's a good that demand increases for when income falls. So as people are seeing their incomes drop due to historically high unemployment, people are not going to have any source of income. So they're going to be reliant on really cheap and fast food, which is unfortunately unhealthy for a lot of people. But it's going to drive a lot of business for McDonald's. Just think about it. If you lost your job today, you're not going to go out eating at some really high fancy place. You're going to be trying to cut down on your costs so that you can save as much money and make your savings last as far and as long as possible. So you're going to be eating at really cheap places to eat like McDonald's where food is ridiculously cheap. So they can really see booming business as the economy and as their stores are reopening. In addition, their dividend isn't looking too bad right now. So right now they have a dividend yield of 2.6%, which is pretty decent. It's fairly high, and given that they've been growing their dividend at about 7% per year, their dividend growth rate isn't too bad at all, given that they have a yield of 2.6%, which makes it a dividend stock on my radar. And they've also been growing their dividend for 43 years, which is a very long time. You're not going to see them cut their dividend anytime soon just because they've been paying it out for such a long period of time. And I know you might be wondering, they have such a high payout ratio. Their payout ratio is all the way at 90%. And yeah, that's pretty high this year just because their earnings have fallen so dramatically due to the pandemic. During Q1, their stores were closed, so their earnings fell pretty sharply. But if you do a payout ratio calculation based off of their earnings next year, when their stores are going to be open for the whole year, they have a payout ratio of 62%, which is pretty decent. It's fairly low. So there's still plenty of opportunities for McDonald's to increase their dividends. And more recently, McDonald's on May 22nd, they declared a dividend of $1.25, as people were expecting. So they're really not looking to cut their dividend, which makes it a really safe dividend stock for these uncertain times. And the second stock on our list today is Procter & Gamble. Procter & Gamble has really taken a minimal hit ever since the pandemic has started. Right now, Procter & Gamble is only down about 7.5% from the time before the pandemic, which is pretty much nothing. If there was no pandemic, this would honestly seem like a normal move. And if you don't know what Procter & Gamble is, they essentially sell a lot of needs-based goods. These are goods that we use on a daily basis, like Charmin Ultra Strong, Tide Pods, Duracell, Bounty, razors. They sell a lot of basic goods, and this industry is known as the consumer defensive industry. It's an industry where earnings and sales don't really fluctuate whether the economy is good or bad. If the economy is booming, people don't buy more toilet paper. If the economy is bad, the people buy the same amount of toilet paper. They don't see any sales fluctuations really at all based on how well the economy is doing. And you can see that reflected in their earnings estimates. 90 days ago, analysts were expecting them to have $4.99 in earnings per share for 2020. 60 days ago, it went down to $4.98. And now it's only at $4.95 per share. So you can see a difference between $4.99 and $4.95 is very, very minimal. when you compare it to the grand scheme of things. They're not really expected to see much earnings fluctuations at all, which is a good sign that this stock is going to be very stable during these times. Procter & Gamble does pay a pretty good dividend. They'd have a dividend yield of 2.73%, which is pretty good. 2.73% is fairly high, and I would call that a pretty solid dividend. And they have a payout ratio of 63%. So there is still a good amount of room for the company to actually grow their dividend. You're not seeing a very high payout ratio at all. So there's still a lot of potential for the company to grow their dividend. And they've been paying their dividend for 63 years. So it's very unlikely that they are going to cut their dividend. But you might be wondering, this stock only has a 3% 5-year dividend growth rate. Do I really think they're going to grow their dividends? And I do think they have a lot of potential to grow their dividend. And here's why. So over the past 5 years, Procter & Gamble has been growing their earnings by about 3.9% per year, which is really similar to the rate they've been growing their dividend at about 3% per year. But now analysts are expecting their earnings to increase by about 7.5% per year. And when a stock's earnings increases, they can also increase their dividend at the same rate without increasing their payout ratio. So since Procter & Gamble is expected to grow their earnings even faster, they can grow their dividend even faster. So you can realistically see their dividend growth rate go to up to 7% in the near future. And more recently, when you see Procter & Gamble declare their most recent dividend, it increased by about 6%, which is very similar to what they're expected to grow their earnings by about 7% per year over the next few years. So this stock really going to grow their dividend closer to 6 to 7% in upcoming years. And when you combine that with a 2.73% dividend yield, it definitely has a lot of potential as a dividend stock. So overall, it seems like a pretty stable and safe dividend stock. And the next stock on our list today is Walmart, ticker symbol WMT. So Walmart's a very interesting stock when you compare it to the market. Walmart is up actually from when the pandemic actually started. So it's a very interesting stock. And the reason it's up is because they're one of the main places where people have been shopping. You've heard about the toilet paper. A lot of people have been splurging for supplies and basic necessities like toilet paper. So they've really seen their earnings increase in the short term. And also with all the restaurants closing, a lot of people are doing shopping for food at Walmart. So they're really seeing a booming business in spite of all other businesses being closed. And Walmart definitely does have an interesting dividend. So at first glance, it might not seem like a good dividend. They have a 1.75% dividend yield, which is not that high at all. You can easily find dividend yields that are much higher in the market. But 1.75 isn't too low. It's almost 2%. Although you can find higher dividend yields in the market, I think their future growth will actually make up for it. But you might be wondering, they have been only growing their dividend by about 2% per year over the last 5 years. Why is it suddenly going to increase? Why do I think it's going to increase? Well, they've actually been growing their earnings by about 0.5% per year over the past 5 years. But now it's expected to increase to 5.6% per year over the next 5 years. So you're really seeing a 5% increase in their earnings growth rate. Or if you think about it in another way, it's a tenfold increase in the rate they're growing their earnings. So as you see the stock grow their earnings, you can realistically expect their dividend to grow at a much faster rate. Reasonably, you can expect them to grow their dividend by about 5 to 6% over the next few years. And this stock really does have a low payout ratio, so it's going to be really easy for this company to grow their dividend at an even faster rate. So while this company does have a low dividend yield, there's a lot of growth potential for the actual dividend, which makes it a really good long-term dividend stock if you're young right now. And you're seeing a lot of stability in their earnings. For their July quarter of 2020, 90 days ago, analysts were expecting them to do $1.32 in earnings per share. But now, they're expected to have $1.31 in earnings per share. So you're seeing a very small difference of 1 cent in what they're expected to do in earnings per share. So there really hasn't been much change or fluctuation from their expectation 90 days ago and how they're expected to perform as of right now. And it shows that there's a lot of stability with this stock. which makes it also a really safe dividend stock in times like these. And Walmart definitely does have a lot of growth opportunities with their e-commerce business. So Walmart says that their e-commerce sales grew by 74% in the first quarter, while same-store sales popped by 10%. So their retail sales ballooned and their e-commerce sales ballooned. And more recently, they announced a partnership with a company called ThredUp. ThredUp is an e-commerce business that sells secondhand clothing. They sell clothing that's used and recycled. And ThredUp is really different, not only for selling secondhand clothing, but for attracting the younger audience. They're trying to get sales from people who support climate change and from a lot of younger people. And there is definitely a lot of growth in this industry. According to one statistic, by 2033, secondhand clothing is expected to represent a third of people's closets, the company said in a 2019 report. So Walmart is definitely getting in on this trend early on. And if they can tap into this market before a lot of major players get involved in the market, they can definitely capture a lot of market share, which can help their long-term growth. And right now, since there isn't a lot of competition in this space, they really do have a lot of potential to capture the market share early. They have a lot of money to fund these ventures, so they definitely have a lot of potential to do well in capturing this market space for the long term. And since they're really differentiating themselves from the competition, they definitely have a lot of potential to get a lot of sales from the younger demographics. And a lot of consumers are now reporting that they're willing to wear secondhand clothing, which can just further the growth in this industry. So this stock definitely does have a lot of potential for growth, and they also have a good dividend. And as long as the company is growing their earnings, they can also grow their dividend. This stock definitely seems like a decent dividend stock because they can definitely grow their earnings at a pretty decent rate, and they can grow their dividend as well. And given that they have such a low payout ratio, this stock definitely does seem like a good dividend stock. But let me know what are your thoughts down in the comments below. Do you like the 3 stocks that I mentioned? Let me know. And make sure to drop a like and subscribe. It really helps out a lot.